Welcome back to Money Exchange. We so often talk about interest rates and fundamental economic data being the things that move currencies. But charting patterns can also have a significant influence on the overall direction of currencies. Earlier today, I caught up with Tony Sycamore, Institutional Director of Foreign Exchange at Commonwealth Bank, to chat about what the Aussie dollar, euro and pound are telling us on the charts. Before we get to the charts, tell us a little bit about your role at CBA and how you're looking to help the viewers with the technical information you're about to share.
Thanks, Andrew. It's great to be here. I'm part of the CBA Institutional Foreign Exchange team, a role where we help to assist our clients with their day-to-day currency needs. As part of that team, one of the things we do is an FX technical report, which relies on a couple of systems of technical analysis, Elliott wave, candlesticks, and other indicators. And what we try and do is provide tradable market calls with entry, stop losses, and profit targets.
Fantastic. Well, let's have a look at the first chart that you wanted to share with us this evening, and that's a monthly chart of the Aussie dollar. What are you seeing on the monthly chart, Tony?
Yeah, when I'm starting to look at a chart or a new instrument, I always like to go back and have a look at the long-term charts, and the monthly Aussie chart is a very interesting one for me. The chart which you're seeing now dates back to 1972 when the Aussie was trading around the 150 level. In the time from 1972 down to 2001, we traded down to a low around 47.76 and then back up to 110.81 in 2011. So we had a fairly steep downtrend in place, and the bounce that I have seen from that 47.76 level up to 110.81, I think is a corrective bounce which then puts the downtrend back in place. And what we can then see if we switch to the daily chart is a pretty nice little downtrend there in place, which comes back and dates back to around October 2014. So at the current point of time, and when I updated these charts, the Aussie was about testing the top of that trend channel, if you like. The top of that trend channel actually comes in around 72.30 to 72.50 today. So the way I see things is we've been in a good solid downtrend for a good period of time. In the last 2 to 3 months, we've been in a range between 69 cents and 74 cents. A break of that trend channel, which you see there on the daily chart, should take us back up to the top of that recent range around the 74 cent area. So for us, it's a chart which is of particular interest. There's a lot of interest both amongst our domestic clients and our overseas clients in the Aussie dollar, and one we pay a lot of attention to.
But overall, over the longer term, Tony, into next year on the Aussie against the US dollar, technically you do see the Aussie dollar lower, am I correct?
Yes, that's correct. So at the moment, after a fairly steep sell-off or a fairly steep move, you'd expect to see a period of correction or a period of consolidation. But the view is that once that correction is over, and whether it trades to 74 cents or 75 cents, I don't have a high view on how high it can get to, but overwhelmingly I'm in favour that the Aussie does trade down into the mid-60s into the new year.
All right, let's have a chat about the euro against the US dollar. You've got a weekly chart to show us now. Talk us through that.
Yeah, the weekly chart's a classic chart for me. We've seen a very choppy period of trading for most of 2015. In recent weeks, we've seen the euro break some very big levels there. You can see that 111, 110.80 was a very, very solid layer of support, and that broke as a result of some of the rhetoric coming out of the ECB and the expectations of more easing at their December meeting, which I think suggests, if you look at the daily chart suggests to me we can retest the 104.58 low and possibly as low as parity into next year.
Certainly the charts are certainly displaying a high level of weakness, so we're looking for the euro to continue short technically. Let's move along, Tony, to the pound now against the Canadian dollar in a big uptrend for the last little while. Talk us through this chart.
Yeah, sterling CAD's an interesting one for us. It's one that we've actually got a trade on currently on the tech report, and one we're looking to add to. If you look at the weekly chart there, you can see the trends up. We like to find currency markets where there is a nice trend in place, and we do have that in place in sterling CAD. CAD's obviously largely affected by the oil price. We've had a pretty solid decline in all commodities, not just oil in recent times, but certainly oil's been one of the hardest hit. And sterling, the UK, the economy there is chugging along probably, if not better, then certainly as good as most of the better economies out there. So the fundamental backdrops are there. The trends in place. And then when I have a look at the correction off the lows, what we have there is in Elliott wave terms, and I don't want to get too sort of bogged down in Elliott wave terms, but it's a very corrective pullback. And that suggests to me that when this pullback is complete, which I think it may have done recently, we will retest the highs. So I'm looking for sterling CAD to push up towards the 210, 215 area. And the point at which I would add to that trade, which we have on currently, is on a break above 203.60. So looking in the next day or so for potentially a trade to add to in the long sterling CAD position we already have on.
And Tony, just before we finish up, going back to the Aussie dollar against the US dollar for a moment, is there a particular price target that you have, say this time next year in 12 months' time? Are we closer to 60 cents?
I think that's a reasonable objective, Andrew. I've been working on the assumption that high we had in 2011, which was 110.81, was the top of a corrective rally since 2013. I've been issuing the same chart. That suggests 60 cents and possibly even into the 50s is achievable. And looking at the CBA house view, the strategists, the economics team do agree with that as well.
Fantastic. What about some volatility in the month of December, around the 18th of December with the Fed's announcements? Are you seeing some increased chance of volatility around that time before Christmas?
Definitely. I think if you speak to anyone involved in the markets at the moment, they will tell you that liquidity and volatility have become more apparent or heightened. Certainly since the GFC, it's probably the most illiquid period we've had in markets. Having said that, FX still remains one of the more liquid asset classes, but you've got the RBNZ meeting on December the 12th. The CBA house call there is for an easing there from the RBNZ, which I agree with 100%. And then you've got the market coming around to pricing in the Fed tightening December 18, as you said. And that at the moment is 60% priced. It's not fully priced. And coming into that week before Christmas, we're going to see more of this volatility that we have seen, and I think that continues.
Tony, thanks very much for your time. We look forward to having you on the program in the coming weeks.
My pleasure, Andrew. Thank you.
We're going to take a short break, but coming up, I'll share with you a new money exchange service that's going to save you some big bucks, and we'll recap where we think major currencies are headed and if there is any need for us to change our expectations. Don't go away.